All right, we are now recording. So let's get started. Welcome to the 13th. This is the 13th Paparelli Zoom chat for entrepreneurs. I really appreciate you coming. Today is the 108th day since the federal shutdown order was put in place. And I've got some sort of bad news that I've been thinking about and some good news. First, the bad news. The bad news is we still have 17.75 million people unemployed. Also, the PPP money and the $600 unemployment kicker is sort of coming to an end at the end of this month. And I'm really anxious to see how consumers and businesses are going to respond. And now we're experiencing a serious increase, as we've been talking about before everybody got on, of the COVID cases. And to top off the uncertainty, civil unrest and this policemen pulling back is resulting in increased crime and death in communities throughout the United States, which to me is totally unsettling, just like totally unsettling. But then there's this good news. You know, can everybody hear me? Somebody give me a thumbs up, make sure we're good. Okay, good. And then there's the good news. The stock market is literally on a tear. The S&P is above pre-COVID levels. You know, corporate registrations, which I just found out this morning and posted onto our resource page, are up year on year in the state of Georgia. Also have a friend of mine who's a good Georgia Tech grad, Julie Carlock Johnson, who did a survey. She's a recruiter, professional recruiter in sales, and she did a survey and on Georgia technology companies and found great optimism for the second half of 2020 from the tech firms here in Atlanta. And then I did a quick survey just yesterday on angel investors, and I had over 50 angels that actually got back to me. And what shocked me is 75% of the angels say they are likely to do a deal in the second half of 2020. So that's the bad news and the optimistic news. And then there's you know, the entrepreneur, who's the audience here. That's who comes here, and the small business person. And I don't know what artificial lift you're getting in all of this, maybe none, but what must you do in the midst of all this uncertainty? The job has not changed for you. You got to solve a problem in the marketplace by building a product or service. You got to sell it, and you got to make a profit doing it. So today, what we're going to address is the venture capital business. Many entrepreneurs aim to gain access to VC funds. A lot of angels like me, what we do is we invest in early stage investments in these companies, work with entrepreneurs to get them out of the ground, hoping that at some point we could actually hand this funding ball off, if you will, to a VC who has much deeper pockets and a whole different network that can take the deal forward. And just like you, the entrepreneur, we need, like, as an entrepreneur, you need a keen interest in your market. I think if you're looking to get money from a VC, you need to have a keen understanding of the VCs, their marketplace, and their challenges if you plan to get money from these VCs. And what I was talking to my friend Blake Patton, who's going to be our special guest today. And what I learned is that VCs now have an even higher bar in the midst of all of this uncertainty. So we'll get to that in just a moment. Just a little bit about the Paparelli Zoom chat for entrepreneurs. It is an interactive forum for you to discuss your issues and your opportunities. I encourage you to use this forum to listen, learn, and share your experience. Let's help each other, because I believe together we'll be stronger. There is a resource tab on paparelli.com. This includes information that any of you found valuable for your fellow CEOs. I post to that. I had a couple of people get to me today. I've now posted that information up there. A couple of those pieces of good news are listed there, including Julie Carlock's survey. The house rules for are listed in the chat box. Take a look and use this chat to ask questions. My friend John Marshall is monitoring the chat for us, and will jump in from time to time in this interview that I do with Blake. Today's topic is venture capital. Has the bar moved even higher? Um, I always have an entrepreneurial thought of the day from the Bible, and this time it's from the prophet Isaiah in the Old Testament. And it's God himself speaking, saying, "My thoughts are not your thoughts, neither are your ways my ways, declares the Lord. For as the heavens are higher than the earth, so my ways are higher than your ways, and my thoughts than your thoughts." My translation for this and an application for this particular passage is, you want VC money? Think like a VC. And now to our special guest, Blake Patton. You know, I met Blake, God, I can't remember. It must have been over 10 years ago. Blake was then the acting director of the ATDC down there at Georgia Tech. In fact, Blake was the guy who gave me an office and offered me my first job at the ATDC, and by calling me this new title called Angel in Residence. And Blake and I built a relationship basically from there. But Blake is, how his VC firm started is pretty interesting, and it's a story I haven't heard him tell, but I'll tell it. Blake is really respected by the president of Georgia Tech at the time, and who was the president of Georgia Tech. He's still respected by the president of Georgia Tech. And he was always called, whenever there was going to be a special guest coming in from the university that wanted a tour of the ATDC, they'd call on Blake. And Blake gave, whether he was the director or not, they would call Blake. Blake gave this tour to this fellow who was from the Middle East. And at the end of the tour, this guy really admired Blake's professionalism, his practical approach, and his connections. And he said to Blake, you know, if you had $10 million, you know, what could you do with it? And that was the birth of Tech Square Ventures. His first fund was a $10 million fund with very limited number of LPs. It was this guy plus a few of his friends. But it shows us, and this is something the lesson learned was, it shows us that you never know where an act of community service will lead you in your life. Just last week, Blake completed his first closing. What was that? Hey, Mike. Mute again. Oh, thank you. Just last week, Blake closed on his first closing on Tech Square Ventures Fund 2. This is a $75 million fund, which is a significant uptick from the 10 that he had before. His LPs now are pension funds, Fortune 50 companies, CEOs, and wealthy families and individuals who are attracted to Blake. I got to get Mike muted here. Sorry. They're attracted to Blake because of his investment track record and his team, which is a great team, and the unique investment platform we're going to hear about today, which was Engaged. Blake serves on multiple startup, government, and community boards, including the High Tech Prayer Breakfast. So that's an association that we've built from our relationship. And he's connected to some of the best and brightest in our community in academia, corporate, and also the startup world. I'm honored to call him a friend, and his background is really, he was an entrepreneur who sold out to IXL and became part of the IXL sort of tribe. And he's got a practical approach to choosing companies and investing in them. He knows the startup community, our startup community, probably better than anybody that I know. He's my go-to guy when I want to know something. So Blake, with that long introduction, thanks for joining us today.
Thanks for having me.
Yeah, I was wondering maybe if you could give us a short overview maybe of Tech Square Ventures and Engage. And I'm on the short side on this one.
Sure. So the shortest version is we're an early stage venture firm. We invest out of two funds, the Tech Square Venture Fund 2, the early stage fund that Charlie just talked about, and our other fund is we're the venture firm behind Engage, which is probably best described as an innovation and collaborative corporate venture fund with 11 large companies as the limited partners. So in that fund, we invest in things that are of strategic relevance to those companies.
Well, tell me, tell me with this, and give me just a little bit more background. What's unique about your fund, the Tech Square Ventures, is this Engage platform that you created. Can you just tell us a little bit about how that kind of came about and how it's worked out?
Yeah. So I think I think what's great about Engage is it kind of captures what's unique about Atlanta. The way it came about was there was an ongoing conversation in town amongst CEOs of some of the largest companies and about innovation and how to connect the different pieces of the innovation ecosystem, especially startups. And they went to Georgia Tech and said, "Hey, how do we do this?" And so I teamed up with Marty Flanagan, the CEO of Invesco, and Bud Peterson, the president of Georgia Tech at the time. And we basically brainstormed and came up with what Engage is now. And Engage is really sort of the recognition of kind of what we've tried to build from day one with Tech Square Ventures was to help entrepreneurs, in addition to capital, with what they need most is access to customers and markets. And so Engage was a way to kind of put that on steroids. It's built around connectivity. We work with, what makes it really unique is that the CEOs of those companies serve on our board of directors. So we have sort of the top-down access. We partner with ATDC to develop a program that we deliver for those early stage companies to help them with that. And then we work with the companies. Each company assigns us, we call them quarterbacks, but kind of a Sherpa to help us navigate those companies and help us understand what their innovation needs and goals are.
What happens, given all that's gone on, the uncertainty out there, and some of your companies are people like in businesses, in industries that are not doing very well. So what's the general interest when this is pre-COVID was very, very high, right? From these corporations. They had finally come around to this exciting sort of startup opportunities and this new thinking and all that. Where are they now in the midst of all of this? Are they still excited about what you're doing? And if so, why?
Yeah, it's a great question. I think for a tad bit of context answering that, I think if you had some of the CEOs of those companies on this call right now, and you said, why did you guys all come together around Engage? You would actually hear more than just connecting with startups and connecting with innovation. They saw the program and the structure and the way we're doing it as a way of helping change their culture to drive more innovation throughout their enterprise. And so I think the engagement is as high as it's ever, and interest is as high as it's ever been. I think, you don't get to be.
How can that be if these guys are they're in sort of survival mode and wondering about they got to do cut? How can they still be engaged?
I think that, I think there's two views of it, right? So there is definitely a short-term view that they're all having to take to different degrees. Certainly amongst our partners, for example, Delta is the most extreme in kind of how hard this has impacted them. And so there's innovation within that view, meaning how can this help us with these short-term problems and challenges? But again, these companies aren't leading their industries because they take short-term views. They dominate their industries because they're led by leaders who keep that long-term focus. So I think the commitment is very high. Like all of us on this call, they're having to change their tactics. But I'll tell you that some of what you said in your introduction is what I see with the big companies too. The engagement has actually been higher, and what I'm realizing is that for a lot of these executives, we had designed everything around face-to-face relationship building activities, and now that we're putting things together in Zoom formats, video formats, remote formats, we're actually getting much higher engagement. And it's because we're not having everyone try to drive down to Midtown. We're not trying to, coordinate an impossible set of schedules.
I think the other thing that happens too is with we're seeing in the marketplace that anything digital, sort of low cap, fishing capital kind of companies, anything digital seems to be doing extraordinarily well. And anything that is not digital is not doing extraordinarily well. So here are these guys which have they're looking for new digital opportunities going forward, because that's where the valuations are going to be, and that's where their stock bonus plans sit too. So I think
Yeah, I think that's right. I also think that we're, like you said, right? I think this is somewhat of a bottoms up impact. A lot of what we don't know still lies ahead of us. And I think there was a sort of an immediate view. Early on, their immediate view was that this was going to be some contained window of time. And we're only sort of 30, 60 days into everyone shifting thinking to this is
Yeah,
this is going to last a while. And
makes sense.
so I don't think we totally know what that answer to that question is yet.
Okay. Well, the other thing is you are, so here you are, Tech Square Ventures, right down there in Tech Square. And you, like I said in my introduction, I think that the Atlanta technology community, startup community, probably as well as anybody does in our city, So, what concerns you about what's going on and what opportunities do you see, because you're sitting with a lot of money now trying to look for opportunities. So but start with the concerns. What concerns do you have now for our startup community here in Atlanta?
Yeah, gosh. Unfortunately, I think there's a lot of concerns. The biggest, one of the biggest challenges, and hopefully we're part of the solution to it, but access to capital for entrepreneurs is always difficult, especially when we rely so much on capital that coming from outside the region.
Yeah.
That's a lot harder to do when travel goes away. So I think that's a challenge in downturns.
We're actually losing some of that capital, and that was a big part of our capital, which came in from the outside of Atlanta.
Yeah, and I think we saw that after
Okay.
in the dot-com downturn as well. Once in tougher times, the capital doesn't travel as easily.
Yeah.
So I think that's a challenge. I think that for the early stage companies, the biggest, I guess, concern in all this, and it's different for every startup, is how their customer base is reacting, and that's why it's just so different for each startup. They serve different sectors, different industries that are hit different ways. In our portfolio, for example, we have companies that this has been a tremendous tailwind, but we've also had companies that serve industries particularly hard hit. Companies like Pickup that serve all of their customers are retailers. They do last mile delivery for retailers. So 75% of their customers were shut down, for 2 or 3 months.
Wow.
And then on the other end, we have companies like Vital VO, which makes LED antimicrobial lighting, disinfect surfaces. Of course, their demand, has gone through the roof.
Yeah, right.
Yeah. So I think their challenges are related to their sector and industry and who they're targeting. But like everybody else, it's about the way I've described it to others, and this is the way I've had the conversations I've had with the CEOs of the big companies. I hear similar things. Is we've all done actually really well shifting to how to handle sort of the ongoing activity that we're all doing for the most part. Set service industries like restaurants aside, but we've all handled that very well. It's sort of new activity that's hard to do, right? It's hard to, create new relationships. It's hard to launch new projects. It's hard to hire new people. And for us, it's hard to get to know, a new company or a new entrepreneur completely remotely.
Well, what do you see with your companies that, how are they handling, since what you do is you kind of continue to press, right? You got to grow, you got to increase value. First you got to survive, but if they're not surviving, you got to move on to the people that are going to be growing. So how are they doing new activity? Have you seen anything that's sort of clever?
Yeah.
Here?
Look, I think for the entrepreneurs on the call, I think that is the hardest thing for entrepreneurs to do, is to shift mental gears from, planning for growth to planning for sustainability. And so the way we've worked with our companies is early on, we basically rolled up our sleeves and said, look, we need to come up with, plans, a scenario, a range of plans, kind of red, yellow, green scenarios, and make sure we have this plan going forward. But what we've tried to encourage all of our entrepreneurs to do is to think about what activities they're going to do during this time, and not just do what you said, not just survive, but it's how do you grow and add value. So it's really about identifying what are the right milestones for your company. Yes, you have to adjust the tactics. The goals are probably the same, but you have to adjust the tactics. What are the right milestones that actually create value in the business? And if you're a really early stage business, that means what risks can you take off the table? What things can you prove? Whether it's, advancing the product, whether it's, getting to market, growing customer base, whatever those things are that you have to do to show and demonstrate an increase in value in the company. And those are the companies that are going to do well, on the other end of this.
You said two different things, okay?
Yeah.
One is you said to start this whole thing off, you said you're moving from growth to sustainability.
Yeah.
And I can tell you, whenever I write a blog that speaks to you need to get profitable, I get hammered, okay? You don't understand how this all works. What we're doing is we just need to grow our top line and everything's going to be fine. We could always become profitable. And then my argument is, if you don't bake in profitability into your culture, you'll never get profitable. You never figure it out. But but here you are saying that I have to go from this growth mode to sustainability, which is profitability, right?
Yeah, it's profitability, but it's not always profitability right now. It's a path to profitability, absolutely.
It is. Okay.
And sustainability.
Do you push for that?
Do we push for that?
Yeah.
We push for understanding the path to profitability. We don't, again, the way we look at it is a little bit different. It's not profitable or unprofitable. We look at what are the milestones that actually create value in the business. So our big thing is helping you define and then execute your go-to-market plan.
Okay.
And so, on day one of your go-to-market plan, profitability may not be the right goal, right? It might be determining what's your target customer base, answering some unanswered questions that you have about your product market fit, closing the gap on product development. So sometimes the near-term plan isn't solely focused on profitability, but we have to understand what's that path to get to profitability, right? So we have to understand, what does that mean in terms of business model? What are the key assumptions that get you there? And then that's what I mean by creating value. In the short run, you say, okay, what are the next key things we have to do to make sure we're on that path? And those things create value. If it's just survival, but you actually haven't removed any of the risk on that path to profitability, then you don't increase value in the company.
What do you do? So let's address some of those people that aren't doing this, that find themselves with a market that 75% of their market, like that retail guy that's serving retailers. Like, what does he do? Okay, I get the guy that has the LED lights and all that. It's going to be like, my God, where can I sell this fast enough, right? Okay, I get him. Okay, but what about the other person, the other entrepreneur where they evaporate? How do you kind of counsel them, or what decisions is that entrepreneur making that's giving you some comfort that you're not going to lose all your money?
That's right. So I think it's different for every company. Two quick examples to highlight that. The last mile retail delivery company we talked about, Pickup, for example. The good news, the silver lining for them was, number one, nobody thinks we're going to use delivery retail delivery less post-COVID than before, right? We're all getting more and more used to it. So as their retail
done too here, just having bought, this is in the food segment, but it's still
delivery. So the 25% of their customers that were still open were actually doing more delivery than ever. So their revenue, didn't go down 75%, but that silver lining helped us say, okay, what do we, in their case, we created a plan about runway. Yeah. And we figured out what's the path to that. Another example, which required sort of a radical change in their business, is a company called PeerFit. PeerFit, they had an offer where they offer for large companies. It's basically these large companies offer gym memberships, et cetera, as a benefit. They had a better way of doing that let the consumer choose how to use it. So you can instead use credits to go to Orange Theory or whatever you wanted to do. Well, all of that shut off, and that obviously became not a priority. Gyms closed down nationwide. This company, was well into the growth stage. They were very dependent on revenue, 60 plus employees. And they did a remarkable job sitting down and having to reinvent themselves into essentially a digital product and saying, okay, how are people, employees, everyone going to be thinking about fitness from home? and what can we do, right, to add value for our large customers. So they had to make some really hard decisions. They had to cut back a lot, but they didn't just, sit still. They changed their product to make sure they continue to provide value.
One of the things I see, again, as I said, is that if it's digital, it's higher value, right?
Yep.
Efficient capital, I think, is what you call it, right? So it's efficient use of capital. Is that where all of our businesses really should be headed? Can we all be just this digital people? I mean, is there going to be any real anywhere?
Similar, actually, now at that question, Blake, is there more appetite you see for investments for products versus services?
For us, I think that, we think more about the market opportunity and the need that it's filling, and we think more about the business model. Is it a recurring or revenue, or is it transactional? We're okay with a mix of product and services. We care about what Charlie said, capital efficiency. So sometimes that's harder to do in product-based companies. But for example, the LED lighting company, the antimicrobial LED lighting company, that's a physical product that gets manufactured. Charlie, I think your question, it's an interesting question. I think because we work with these large companies, one of the advantages it gives us is insights into sort of where markets are moving.
Okay.
And the timing. What are those inflection points? And we tend to focus more on transformation, longer term transformations, things like direct to consumer, which there's a huge digital component to. I don't think the goal isn't to go digital, but this direct to consumer kind of trend across industries, digital has been the answer on how to do that. So I don't know that it's, hey, we should just all be digital. In fact, if you think about some of the biggest innovations we've had in the past 10 years, even things like Uber, it's kind of connecting, digitally connecting to the real world and making that easier. But you're right. Digital makes it easier.
How do you, you bring up something that, and I hope this doesn't take us off track, but you mentioned about that you talk to these bigger companies and they tell you where markets are headed, right? That is like the hardest conversation to have with anybody in the market. I think it was Steve Jobs that said, you can't ask a consumer what he's going to buy next. You're not going to get your ideas from them, okay? Because they don't know. But they do know when they see it, they'll buy it, okay?
Yeah.
How do you get that information, especially from these big companies?
Yeah, great questions. And, to keep it short, we don't really go out and we do a couple things. We look at what's on their innovation roadmap. So in other words, what are you working on? We pay a lot of attention to what problems they're focused on, not so much what they think they're doing to solve it, but what problems are the ones that they have all their attention in. And then the trends and the macro, especially the things we see across the enterprises, we dig into. We have a process, we call it Insights Engine, where when we find these common themes. So for example, as COVID hit, one of the things we heard across all of our corporate partners was this enormous and immediate focus on supply chain. Yeah. Everybody's supply chain had been optimized around cost, and all of a sudden it was, resiliency was the problem. So they were all solving slightly different problems. They didn't call us and say, let's focus on supply chain. But what we could hear from all they were talking about was it was about supply chain and resiliency. So we start to do deeper focus areas on that. So it's about listening. It's about listening for the problems they're solving.
And is that when you're evaluating who is a good engaged candidate for you? Is it always, are you filtering it based on these problems that these people are, that your partners, if you will, your corporate partners are actually trying to solve?
Yeah, I think that's a sign of maturity of any venture firm. For us, for sure, right? I think early on as an investor, you look for good deals. So, hey, I met a great entrepreneur. Hey, someone introduced me to this great company. And then as you mature, your sourcing becomes more targeted and proactive. So it's been no different for us. And the short answer now is yes. We try to do as much of our sourcing and looking for companies that fit against these themes that we've identified and that we've tried to spend time getting much smarter on. And by the way, we're way more successful when we do that, because when we engage with that entrepreneur, all of a sudden we can say, hey, listen, Georgia Pacific, has this interest, this need. Would you like to connect with them? Would you like to talk about it? Of course, that entrepreneur is more willing to talk to us and engage with us when we talk that way.
Value when you do that, obviously.
Yeah, and they
That's
know we
interesting
understand their problem.
because I remember the first cohort that you had for Engage. It was sort of, to me, it looked like cats and dogs, and I didn't understand how it applied to some of these corporate partners. But I can see where you're headed now. It's a lot more rational, your approach for
yeah, and it takes time and iterations to develop an understanding of what those views and trends are. And honestly, with Engage, some of our best performing companies, by the way, are in that first cohort, and some of our most innovative companies. And we still leave room for things that we want the companies to see, even though they don't understand it yet. We think it's an important transformation, and we want to include those companies as well.
One of the things that obviously that if you're raising money and you're an entrepreneur, the big thing that always comes up is valuation. Okay, it's always valuation. I always think it's this, and you always think it's this. Okay, that's kind of whether you're an angel or you're a VC, But you set expectations for returns for your LPs. You didn't raise the 75 million and say we're just going to do our best. Okay, they're evaluating you. So to put it so. I don't know if you give us a sort of an IRR sort of percentage you're trying to hit, or as the way VCs work is, that every deal isn't going to turn into a home run, so there's those 1 or 2 deals in 10 that's going to be the one that pays for the whole fund in a lot of cases. So what investment returns do you aim to achieve on each deal? Maybe a good way to do it is just as a multiplier, that I'm looking for a 10x or a 20x or, whichever way you answer that. But I think it would help entrepreneurs to understand, because they all think they got the deal that's going to pay back your entire fund. Okay.
Yeah. So Charlie, the reason that was a hard question for you to ask, and you asked it, 3 or 4 different ways, is, it's not a simple answer. So look, I'm going to answer it 2 ways. I'm going to answer directly, what do we look for? But also I want to give you some context first. So valuations, in your kickoff, you said, hey, entrepreneurs, right, think like VC. So this is how to think like a VC. What we really do is not try to figure out how much you're worth right now. That's an almost impossible thing to do, right? Instead, what we do is we think about what your path forward looks like. We actually look at different scenarios and growth scenarios and outcome scenarios. And in our case, we actually do kind of a weighted average of that. And we say, look, what do we think is going to happen in the future? And then we say, in order to get the returns we want on this much money they need right now, this is how much we need to own right now. Now we will look at that and compare it to market. We'll look at it, compare it to multiples. But at the end of the day, we're trying to figure out if this company grows to ABC and exits, this is what's likely to happen. Will we get the return? So how do we figure out what that return we're targeting is on each different company? You're exactly right, Charlie. I think different VCs think different ways. I tend to think in terms of IRR, and the reason is we're early stage investors. So sometimes we can wind up in deals for a very long time. And so, a 10x multiple over 7 years is, not that much difference than a 3x multiple, in 2 years. So it's not as simple as a multiple always. I think the rule of thumb you'll always hear is kind of,
you can forecast an exit. God bless you, man.
That's right. And it's not so much that you're forecasting the exit, but you can forecast the realistic growth rates of the company, and you can kind of understand what an exit would look like at those different points. And so that's kind of how we think about it. So the short answer is, I think, you're talking 50% plus IRR, kind of, 10x plus, because as you said, those winners also have to make up for the ones that don't achieve that.
So if I have a 50% IRR that you're shooting for, okay, what's the multiplier? Get simpler terms. What's the multiplier in how many years?
Yeah. So again, it varies, but call it at least 10x.
In
6 to 7 years.
6 to 7 years, 10x return. Okay.
Yeah.
So keep that in mind. So if you say, as an entrepreneur, I say that, look, my company's worth $10 million, okay, that I have to be worth $100 million in 5 to 7 years. Gee, it's a big number, especially since I never started a company, never mind think about running a company of $100 million. I think that's incredible. So
Charlie,
what,
angels have to ask that too, because you guys are the early money in. And if that company, as that company approaches 1 or 2 million in revenue, if they've gotten there just on your angel money, you have a hard decision to make, because you and that entrepreneur are still at a place where, building that company a little farther and selling it for $20 million is an amazing outcome until you take a check from us, right? And then all of a sudden that 20 million exit is no longer on the table or interesting.
right. Which then puts more risk into the formula, right?
That's right.
Because that's why a lot of companies cash out, at 10 to 20 million dollars, because I'll take my money. An entrepreneur says, look, I'll take my money now and not risk this sort of 5 to 7 to 10 years sort of run, because a lot of things can happen in that time period. So to help these entrepreneurs, why don't you talk a little bit about the process that you go through? So kind of what you're looking for. I think you mentioned 3 things to me is, and how has that changed, pre-COVID, post-COVID to pre-COVID, So
Yeah.
let's kind of talk about that a little bit.
Yeah. So, obviously the first thing we've learned that we have to get right is the people and the team. For us,
I don't think it's obvious. I think to you it's obvious.
Yeah. Well, it has become, in the 6 years since we've started Tech Square Ventures, we've done, we've made over 50 investments now, 50 companies now.
Wow.
And I've definitely learned that, you asked for 3 things. Number 1, 2, and 3 are probably people. And so a team with, I think the best entrepreneurs, their superpower is vision. You're buying into their vision, their ability to execute, and certainly their character. And we'll come back to your question about the character part. About the COVID part. 2 is we have to be right about the market opportunity, and that includes timing. So it's fairly obvious. You talked about this at the beginning, but we have to be right that there's a demand and a need in the marketplace for what problem you're trying to solve. That we can usually do a pretty good job analyzing, especially using our network. The harder part is timing. I think where a lot of, you can be right, but not necessarily right about the market adoption timing. And that's
Right.
harder to judge. And we can talk about that a little bit later, but that's another thing our platform and those corporate relationships
You don't
gives
have
us
a
real
lot
advantage.
later, it's already almost 9:40.
Yeah.
So
Yeah.
we're moving here.
Yeah. Well, timing, I think,
I'm
is
not
really
saying
important.
don't go deep into timing, but just don't expect that there's going to be a lot later. We can't hit it all. So what's the third thing?
Yeah. So timing is really important. And I think, you asked earlier about our relationship with our companies and our network. That's one of the things that we can do uniquely well, right? Just get a sense of the actual timing. And then third for us, I sort of shorthand it and say, can we help? But what it means for us is the business model a good match for us? Is it that recurring or transactional revenue? Is it an industry? Is their distribution model something that we can help with our network? So those are the main things we're looking for in terms of, pre-COVID and post-COVID. We can analyze most of that remotely pretty well. The hardest part is that first one, right? Is getting to understand. I can even analyze the entrepreneur's domain expertise and a lot of their, history and things. But what's hard to get a sense of is their character and what they're going to be like to work with. And so we have to increasingly depend on, as an entrepreneur, you should really focus now hard on getting warm introductions to investors. We really need some extra, reassurance from people that have interacted with this person. So warm introductions are more important now than ever. It's, if we're having to substitute.
I think this is a very important point that you're hitting on here is warm introductions is to speak a little bit more specifically to that. Okay.
Yep.
Because it is critical at this point. What was it like before and what is it now? That's what would help.
Yeah. So before, look, if I had any reason to be interested in whatever reach out you did, We had lots of ways of doing that initial filtering in person. Now, what warm introduction means, and the best warm introduction for me is an introduction from another entrepreneur that we really trust. And the reason is entrepreneurs are usually pretty good at understanding what things we like and don't like. They do a better job of it than the rest of the network.
Including angels, right?
Yeah, including angels, but people who we've worked with obviously are the strongest and especially successful entrepreneurs. Let me put it to you this way: if a successful entrepreneur in the Atlanta startup community calls me and says, "Will you do me a favor?" I can't say no, right? That's my customer, right? The rest of you I can say no to. I can't say no to a successful entrepreneur. So those introductions are very strong and successful. But look, even if you don't have any of those networks, or you don't already know us, chances are your law firm does, your accounting firm, the angels you work with do, and those folks can help you, and hopefully they do a decent job filtering, for us and helping us point to the relevant ones. So that warm introduction, I would encourage the entrepreneur to work hard to find that, and not just say, well, I don't know that firm. If you don't know that firm and no one in your ecosystem knows that firm, that starts to make me wonder how you're going to reach customers and solve other problems you have to solve.
Wow.
Like you mentioned earlier, with 11 CEOs, and you're trying to forecast maybe where there might be opportunities. Is there a scenario where there's a problem out there, but you don't have a company in your portfolio or a company that's looking at working with you that can solve that problem?
Oh yeah.
And if so, what's the scenario to maybe try to match somebody who may be interested in starting a company, or has got a company that's not quite in that, fill that gap exactly? How would you connect those two?
Yeah. So first thing, we have an insights engine process that it feels a little bit like a consulting process. We first kind of study the market, we study what everybody else is doing, and then we literally make a database and reach out to all these startups, and we run that through our big companies and kind of learn what we learn. And whatever the gap is left, today we don't, it's a great question, and we're just starting to experiment with that. In fact, we have our first startup and engaged that is really a team that's still inside of Southern Company, that was formed to do what you just said. So I do think that's kind of the future of some of what we're going to do. I don't know how we're going to do it, but in terms of taking opportunities either inside companies or pulling them up inside and forming them, we've worked with UPS on something they call jump starts, which is to answer the same question. What about things in UPS's language? It's what about things we wish were happening in the marketplace? We don't care about owning it. We just wish it would happen faster. How do we accelerate those things? So it's an excellent question. I don't have the answer.
Will any of that get published anywhere?
So it's interesting. We publish our insights engine stuff, but we only publish it to ourselves and our corporate partners. We are trying to think about how to share sort of curated versions outside. But
maybe what you could do is have Scott Lopano. You want to make him famous at some point. He's one of the up and comers here within the Tech Square Ventures Fund. And a good friend too. Is maybe he could write an article or two a couple of times a year that might tip your hand a little bit to the rest of the world.
Yeah, pick a deep dive on some of those areas and share it. Yeah. And you
what's interesting that you said this is something that I didn't, I think of VCs, and I've got my friend Nelson Chu on, just sitting back and just waiting for people to come to them with these opportunities, and they go, not good, not good, not good. Okay, we can talk. Oh, I like this one, right? But what you're saying is that you're actually being proactive. You're actually reaching out into the community and making it. That's like
absolutely. Around each of those themes, we actually build. Our team is tasked with, and we build a database of the most relevant startups we could find in that space. Yeah. And then we actually share that with our corporate partners so that we get feedback. And what you'd be amazed at is they'll come back and say, oh, here's 3 more you didn't find, or here's, we've already talked to 2 of those, and so it just surfaces so much information.
That's great.
And by the way, we use interns to do that.
Yeah. Well, one of the things that, John's asking here is everybody wants, it's an entrepreneur saying, hey, tell me where the puck's going to be and I'll skate towards it. But that's not how it works. You have to be skating towards a puck that you've been called to skate towards. And I think you got to just be right place, right time. I mean, that's just, it's really up to you. So you got to be doing what you're doing. And then you're going to get that call from Blake and his team saying, we're interested in what you're doing. It's a different way to kind of look at this. I got two quick questions here. One is, what's happening in the agent community? You know, entrepreneurs are real interested there. What do you see?
Yeah, I don't know what it's going to be like the rest of the year, and you guys have a better pulse, on the local than I do. But I mean, honestly, I've seen it really constrict and tighten up the angel community. Obviously, a lot of companies have had to reach back out and try to raise additional capital, and the angels have been very reluctant to participate in those rounds. That said, I think it's changed dramatically in the last 30 days. I'm starting to see
For the positive.
a lot more, but very positive.
Okay.
Those angels are reaching back out. Rounds that we were struggling to get done. Now that we've got enough investors, enough VCs around the table, the angels are wanting to do their pro rata. So I don't know what it's going to look like the rest of the year, but at first I think it was very painful, but I am seeing good signs now.
Cool. They must be getting more settled on what's happening in the stock market, that it's going to stay where it is, as opposed to taking sort of a downdraft. Last question is, what is it? 99% of the companies that are probably on this call that are interested in VC will not be a VC investment. Okay. They won't jump the bar, if you will. What survival advice do you have? Survival and what you called growth, the growth to sustainability advice for these businesses.
Yep. So
talk to our audience here.
Yep. So number one, the good news for a startup is that you're, unlike a larger company, you're not yet super dependent on that revenue, right? The expense side of the equation is still bigger for you, and that's under your control. So I know it's hard, but you can make some changes. You actually have a lot more flexibility than, say, Delta or one of these larger companies, because you have a lot more of the expenses under your control. And so you need to come up with those scenarios, and you need to be honest with yourself. What we did with our companies was try to do red, green, yellow scenarios and say, listen, we'll keep going on this path, but if these things don't happen by this date, we're going to make these changes. So that's number one. Number two, during this period, what we've encouraged all of our entrepreneurs to do is to say, listen, whatever the big gaps you have are between you and your competitors, between product features you have to have, right now is a time to go heads down and make sure you close some of those gaps, right? This is, once you have that sustainability path, back to Charlie, your earlier question, how do you add value? It's not only growth, but use this time, because I promise the bigger incumbents are treading water. So those two things are probably my biggest advice. Make progress that actually adds value to your company, but to do that, you do have to pause and create a plan to survive that period.
Well, Blake, thank you so much. We're out of time, but I want to thank you. I mean, you're a good friend, and thanks for sharing with our community. You always invest in our community. And John and everybody else on this call, I want to thank you too for coming. John, you're very helpful. Thanks for jumping in from time to time. Just this, three takeaways for me in this conversation. One was the last one he talked about was there has to be new activity, backed by milestones, okay, for your company. If you're going to be attractive to VCs, secondly is the problem that you're working on is the problem that they're looking to solve in their fund. Those are the companies. So there has to be alignment there. And lastly, which was really good, is I thought where Blake said, look, if you want to get to me, if a successful entrepreneur calls me and says, hey, you should talk to Charlie, I'm going to talk to them. I can't, that's my market. I can't say no to a successful entrepreneur. So who are you hanging with as an entrepreneur? Start hanging with the existing successful entrepreneurs, or maybe those who you believe will be successful, because that is going to be your base and your influence going forward. I always tell you every week, watch your cash. It goes out fast and comes in slow. You're going to get through this. Next week, July 15th, my guest is going to be Adam Wexler, who's a successful serial entrepreneur. His current business is Prize Picks, which lost its entire market. He sells to the sports business. And if you, I think it's going to be interesting. You lose your market overnight, and now he's thinking that he's going to have an even bigger opportunity going forward. So if you have an issue you're facing and would like to know what other entrepreneurs are thinking about, send it to me. I'll make it a topic and make you a topic. You know, come early, catch up. I'm 15 minutes early on the call, and we get to talk and learn about each other and what's on our minds. And know this, I'm praying for you all. Thank you very much for attending. You are all great entrepreneurs, and together we are stronger. Take care. Thank you for attending.
Thanks all.
See you.